Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How are you this week?
Hi, Mel. I'm doing good. It's busy, and then we're happy. And the markets, of course, continue to be interesting. So we can't wish for more. How are you doing?
We just released earlier this week our second quarter China and ASEAN quarterly magazine. So we're very proud to share that with our networks. It's called Driven from Within, and we feature what Southeast Asian and the Chinese markets or economies are doing to kind of pivot their growth towards more domestic driven in the context of all the uncertainty in the global markets today, some of which we'll discuss in today's episode. So for today, we have several topics on the table. First, we'll discuss a meeting of global central bankers who are meeting in Tokyo, and then we move to China, where there are moves to reduce commissions being collected by mega e-commerce platforms, which are very hot these days. And then we look towards the ASEAN region and their plan to negotiate tariffs as a bloc with the US. And then we look to the European Central Bank as they release their financial stability review report and what they think about financial instruments in the region and the outlook as far as global markets are concerned. So, Peter, let's jump into the mega meeting of the who's who in the monetary scene. They're all convening in Japan this week.
Yeah, and we should say it's a mega, and not a maga. Yeah. So it's sort of one of the big get together of top central bankers around from the world. As we know the one in Jackson Hole, what's it called? Yeah, Jackson Hole. Yeah, every year in the Midwest in US, and that is the most prestigious and the biggest get together for central bankers. But as we speak, actually now here, you and I, there's this 2 days top summit going on in Tokyo,
Mm-hmm.
and the leading central banks are there. It might not be with the very, very top persons from the Fed. It's Williams that is participating. He's from the board. But anyway, this is a top meeting. On the agenda, we know that there are for sure two very important issues. That is government debt, and
Mm-hmm.
the second is the sticky inflation. Um, Issues that we have raised here very very often in our podcast, and we are concerned about the growing public debt, and again we can only repeat. We have seen the market reactions also last year, throughout last year, that more public debt is simply not very well received among investors globally. And even central bankers and governments, they should have a look at the financial markets because it is simply so decisive what goes on there. So yeah, that is one of them. And again, also we've talked about inflation so many times, and obviously we fully understand that is a concern. After the very high inflation period, yeah, we saw inflation dropping,
Mm-hmm.
but we can't really point at a place anywhere in the world where it came down and just came into a natural level.
Right.
For maybe it has dipped down, but not stayed down, and that is the key. So the upside on the inflation risk is is there every day. It's sort of actually pretty outspoken, and this we should keep in mind because that is a true risk for global economy and also for
Mm-hmm.
assets. So yeah, so they have two very important issues on the agenda, Will they say something very surprising? No, they'll probably call for governments to reconsider when we talk about debt.
Mm-hmm.
That is, of course, outspoken and actual as it can be. We have a U.S. Negotiate as a government debt going sky high probably
Mm-hmm.
with
Yes.
new initiatives from Trump and basically the Republicans. But we have also seen Germany issuing enormous or will issue enormous new debt. Yeah. So it is outspoken, and what we could maybe on the sideline look for any comments also from the U.S. central banker
Yes.
about interest rates, concern about inflation also in U.S., and again another postponement of the expected rate cuts in U.S. We stay with our argument that inflation is too dangerous, and
Mm-hmm.
we have difficulty seeing U.S. central bank cutting rates, and there we are surely away from the mainstream in the market still. But these are some of the things we're looking for. Yeah, a few thoughts about what's going on in basically in your end of the world, Tokyo.
Definitely something to watch out for, although it is a very eventful week. Let me pick up on its neighbor, China. So, over the weekend, the state regulators actually announced that it is looking to tighten regulations towards e-commerce platforms. So these are your Alibaba, your Temu, your JD.com, and they're looking to rein in the commissions and fees being charged by online shopping platforms towards the sellers. So mostly the small businesses that are selling through their platform. Um, it sounds a bit small in the sense that sometimes these costs are packed into the price, but it still turns out cheaper when you buy it versus elsewhere or in the groceries or in the mall. But I see it as notable because it's a way to keep prices down, stimulate consumer demand further just a bit. If you reduce or remove those many fees and charges that are being collected on the platform,
Yeah.
and it's really a way to like provide a stimulus without necessarily shelling out more money as far as Chinese government is concerned. We talked about debt, and this is a way not to accumulate more debt. So there have been a series of financial stimulus programs announced since last year. This is kind of a way to still support domestic consumption without necessarily the government footing the bill. And the China e-commerce businesses are actually in a great position right now. So last year they made 1.4 billion in total in revenues. That's more than what US platforms like Amazon made. And sales are actually up by 7.7% as of April, and that is faster than total retail sales growth of 4.7%. So there is space for these platforms to afford that reduction in fees and charges that they collect. They will likely still remain profitable. So it's if it's implemented, it could be still a win-win for everyone. Maybe just a reduction in their income, but they're far from being at a loss anyway. They're doing well and their sales are
Mm.
up year to date. So it could be a good solution without necessarily padding the taking away resources from government programs in China. So that's something that
Yeah.
could stimulate local demand. Yeah.
In Europe, among retailers, it won't.
Mhm.
I don't think they will be happy. It won't generate any happiness at all. There's a huge focus on Temu and the other Chinese
Right, right.
retail platforms, and it is enormous. It is simply enormous what they are exporting every day to European consumers. But I expect that this will also lower the price for European consumers. So there
Yeah.
will be even more competition from the Chinese retail platforms towards the European retail business. And it is actually also worth to notice in that concept
Yeah,
discussion.
beyond China. Yes.
Yeah, yeah. So very interesting move. Do we have any impression about how many percentage we are talking about? That let's say, is it 5 or 10% that the prices are getting lower, or how much?
the the fees are actually varying per platform. And I think the
Mm,
main problem that China wants to resolve is that there are multiple charges. So there's a percentage
yeah.
charge on the amount of the items you're selling, there's a marketing fee, there's a platform fee. So that's what they're trying to remove. Like, put it all together in one
Yeah,
flexible or like reasonable rate. So
yeah,
yeah, it does sound efficient and fair as far as the
yeah.
sellers are concerned, and also kind of maybe moderate the greed, so to speak, or like the profits, the high profits that are generated from this kind of business.
Yeah. Okay. Yeah. Let's see what happens with if even more European consumers are
Buying from them.
are
Yeah.
moving to the Chinese platforms. Interesting. Yeah.
Let's stick to Asia, Peter.
Yep.
Apart from the mega meeting of central bankers in Japan, there has also been the meeting of regional leaders and ministers in Kuala Lumpur and Malaysia. So they had the ASEAN summit Monday and Tuesday this week. So the presidents flew in, and then they held their uh, cooperation meetings. And one of the
Mm,
biggest and most noteworthy takeaways is that the ASEAN wants to push for negotiations on tariffs with the US as a regional economic bloc. So it's kind of like trying to do what the European Union is currently doing,
uh,
except that the tariffs in within the region are widely varying. So, for
yeah.
example, on one end you have Vietnam with 46%, Cambodia with 49%, and then on the other end you have the Philippines at 17% tariff and Singapore at 10%. So it's kind of hard to visualize how that negotiations will proceed. Although Malaysia is leading or the ASEAN chair this year, so
Mm,
Malaysia is supposed to take charge in those negotiations if it does push through.
yeah.
It sounds more efficient. So instead of talking to 10 or so countries at once, you can just talk to one person for 10 countries. But I'm thinking that it could leave some of the countries with more palatable tariff rate, so to speak, worse off if the negotiations come to the middle. So the
Yeah.
middle of 49% and 10% is kind of far from like what Singapore is facing right
Yeah.
now. So it could be an easier route for those with very high tariffs, but might not work for countries like the Philippines and Singapore who are slightly better off than the rest of the pack.
Mhm.
But it sounds good as a concept because maybe you get to skip the line because that's 10 countries in one go, and it
Mm,
sounds more efficient. And they are trying to this move is trying to solidify ASEAN's position as a regional bloc, which I think
yeah.
they've been kind of soft relative to how the EU does it. We don't really have an European Commission equivalent
Mm,
yet. So, yeah, that's what I'm looking at. But given that some of the countries, I know that the Philippines, for example, has started its own attempt to negotiate its tariffs with
mhm,
Trump, and there has been no progress. And July is about a month away. So if this fast tracks the discussions for everyone, then it
mm,
can be positive as far as market sentiment and uncertainty is concerned. So we haven't seen yet if the last I saw was that Washington has not yet responded to the offer. So
okay.
if it does fast track things, it bodes well. And of course, any rate closer to zero for everybody would be great. But yeah, that's what we want to look out for.
Hmm. Yeah, it's pretty interesting to see if there is any progress. Of course, we'll probably hear more. the
Mm-hmm.
coming weeks, yeah, hopefully. So yes, exciting as it is, of course, is exciting for several reasons. Also because it's decisive for where the stock markets are going currently.
Mm-hmm.
Good. Should we jump to Europe?
Let's jump to your
And
side of the world, Peter.
we had, as you mentioned in the intro, that the European Central Bank (ECB)
Mm-hmm.
published the financial stability review. Is coming out every 6 months. The ECB is one of the leading and or at least I would say biggest central banks in the world. So it is of course interesting what they're saying about sort of the region and how happy they are and what sort of as a why I this is interesting to touch base on because it was honestly a pretty it was almost a depression to have after reading the what they think and the outlook is. It is very specific about the market, yeah, and of financial markets and about assets. As a first of all, they basically see that overall that they think that the current we can't say bullish financial markets, but at least actually positive. Both stock market in particular, but maybe also the bond market. They think it's out of sync with reality,
Mm-hmm.
i.e., it's a sell recommendation. Yeah, that is impressive. Could say, should we be dead scared now? Are they seeing something that we don't see?
We
Are they
don't
all
see.
of a sudden going out and advising people on how to um, how to manage the investments? Now, it's not unusual, as we see in general European central banks having an opinion. It originates also from the German central bank, Bundesbank. They've been very as outspoken about different asset classes, even their own domestic real estate markets, where they go out and say it's too high. So there's some tradition within parts of the European Central Bank or the European central banks as such to actually to have an opinion about risks and also going as a diving into different asset classes. But this time the list is simply almost endless long about where they are concerned and where people they should stay out. They as a one thing is the general view on equities and partially also the fixed income market, but
Mm-hmm.
they are very precise and specific about the credit market. And I found a place where they sort of highlighted. I need to find it because it was so good. Yeah, so they are simply talking about the credit spreads, and they say that the credit spreads. Also, when we are concerned about, yeah, in general, it's a corporate credit as I see it, but they are talking about credit spreads in general. It is out of sync with the underlying credit risk.
Mm-hmm.
So they argue that actually that's at least the credit spreads on credit bonds should widen, and that also means that the bond should be sold off. Actually, I take it as a recommendation, basically. It's different,
Free advice,
and
yes.
of course they're very sort of concerned about the consequences of the U.S. Tariffs. They consider it as a major downside risk, and they have also on the list they have cyber attacks. They're concerned about what they call concentrated investment in private markets, and
Mm-hmm.
and then they're seeing a growing link between cryptocurrencies and traditional finance, and they see that as a risk as well. So we are a bit across the board. As here in our house, we like the private market, as we like
Mm-hmm.
alternative investments and non-listed investments. Actually, we see many of them as having the best upside. But should we take this batch of concerns? As they must have had an almost bad day when they made the report. So, and going, but the cryptocurrency. dominance or growing interest in cryptocurrency, we can see some of the concern points because a lot of gray economy is also involved into the cryptocurrency area, and that is
Correct.
very, very unhealthy for the world in general, as for the economy and for the world, for everything. So yeah, but that's a bit different risk, we would say. It is partially that, and they also say it's a linkage between cryptocurrencies and the classical financial system or
Mm-hmm.
market. But yeah, there. On the other concerns, it is interesting as when we in our podcast we pretty clear, and we will also today, as we actually see a stronger world than many. We see a lot of upside. We actually see more sunshine, much more sunshine than the European Central Bank sees. And why is that? Why is the European Central Bank wrong in their assessments? And one reason I fear is that what they assess is very much their. It looks like they are watching their own backyard and saying, okay, so what happens in our own backyard?
Mm-hmm.
And then I agree, that is not looking too good, yeah. And we are, as we do feel, yeah, almost sorry that the last economy in Europe, the German economy, is simply in a standstill. But yes, that is generating negative vibes, yeah. But it's like the rest of the world is not included in this sort of general view on how are asset priced and is the upside better than the downside. And this is where we consider the world differently than the European central bank does. It is like they simply see this is the view at home, and this is how we simply prolong the view forward. It just goes this way, and they base a lot of their views on macro. And there's not anything wrong using macro assessments in talking about assets, segments, direction in the market. It is just not necessarily the most dominating, and it's long-term macro. A lot of
Mm-hmm.
things will happen in between, and that is the key. And that is why when we try to explain how we see the world, it is actually how many clouds do we see on the horizon? Do we see sunshine or is it rainy days? And when we talk about clouds, one could ask, so if you see a cloud on the horizon, why don't you just sell your segment of what you're talking about? No, because we know that a lot of things will happen before the cloud reaches us. If it grows, it becomes more dark,
Mm-hmm.
all these things, then we might start to react. But in between, there are a lot of other positive factors flying around in the global financial weather system, so to say. So sort of these dark clouds or clouds or whatever, they can disappear before they reach us. And that's so we wait until we say now they are too big or they are too scary
Too heavy? Yeah.
or they're gone. So this is where's a big difference. We can mention that once again, yeah, the Asian region that is the biggest economic region in the world. If we look into the Asian Development Bank's report, also half-year reports,
Mm-hmm.
they don't write as negative as the European Central Bank does. Yeah, this is where I think the European Central Bank is missing the point. The world is so much more than what they see, and what they see and where they have their jurisdiction is shrinking. And we can take the global south as an example. It is moving faster and faster forward. The number of people coming into the middle class is growing from poverty and still growing. A lot
Mm-hmm.
of things, a lot of households, they have savings now. They are moving forward. They want to consume. They want to upgrade the homes. It's a very, very strong force. We actually see the word very different to how the ECB is assessing, and we would not go out with the same sell recommendation as they have. All the worries are not wrong. They're just overweighting the concerns. and not seeing all the upsides in the world. So yeah, so we are having better days in our office than they have.
This is a good
So
point, Peter, to jump to our regular global outlook. So as you started the conversation already, I think the point with our difference with the ECB's view is that we are looking at a larger picture where we factor in the very upbeat progress or activity in the global south, especially in the ASEAN region. Yes, there are some clouds hounding the horizon, but there are increasingly more bright spots emerging, and it looks like on the long run it can be sustained. So we
mhm.
remain optimistic about it. We remain overweight towards this part of the world, and looking at how fast the Southeast Asia and China areas are growing, maybe that's more than enough to kind of offset the negativity or the slowness of the European region, Peter.
Yeah, so certainly it's what we trust. As we would argue, it's also what we see actually. Also, if we look into wealth creation, how wealth is created, the number of wealthy individuals, how they're growing. To finalize off with our normal sort of global outlook, and as you say, we remain as happy with overweight risk in as a,
Mhm.
as contrary to the ECB, they are probably already sold out of their private pension funds and whatever. Yeah? But it's okay, as we of course listen carefully to what such a prestigious central bank say, because they are it is very good economists. So we listen to what they say, but we do not agree. We let the other issues getting the overweight, and that is why we, yes, as usual, we like overweight in risk, meaning overweight in stock still, and we actually like the ASEAN or Asia credit risk. We are happy with that, and also yeah, private market or
Mhm.
non-listed risk, particularly in Europe. Actually, funny enough. All these things. So we do see an overweight of happy weather, also some more as a sunshine. There are clouds out there, a lot of things we need to navigate about. What the people are talking about in Tokyo, yes, we agree. But these are clouds. Some of them are big, but it's not creating rainy days right now as we speak. So we stay overweight with risk and trust in the sunshine.
The sunshine outlook prevails, Peter. Thank
Yes.
you, Peter, for this week's episode, and thanks to our listeners for tuning in. We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Longines Investor Insights. Thanks for tuning in. For expert insights on the go, download the Longines Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit longinescapital.com.